All right, I've got a great question from John around superannuation and the new Division 296 rules. Now, I am going for a run, so forgive the bouncing. But John said, been following your content and really appreciate the value that you share. I was hoping to get your take on the new superannuation tax changes. Do you think that it will impact how you should be planning for the future? Would love to hear your thoughts when you have a moment. Let me give you my thoughts on this. So, I love superannuation. I think it's a fantastic tax structure to be able to build your wealth for your retirement. I believe that we are blessed with one of the best retirement planning systems in the developed world, and that comes down to the tax advantages that we are afforded by our superannuation system. However, like any system, we must understand the rules, and we must understand that those rules are going to shift and change. And it's important that we understand those rules and apply them appropriately to ensure that we can maximize the probability of achieving our particular goals and aspirations. So let me give you a little bit of a crash course on why I believe superannuation is so good. So as it stands right now, we have the opportunity to put up to $30,000 a year per person into superannuation as what is called a concessional contribution. And that basically means that we can claim a full tax deduction on that contribution. And going into super, it pays 15% tax compared to many of us who are paying 30 to 45% tax. It is a significant tax saving. Now, there was a change that was implemented a number of years ago called the Division 293 tax. And it was one of the first most significant changes to superannuation taxation, which basically meant that if you were earning over $250,000 a year, your superannuation contributions would be taxed at 30% instead of 15%. The rationale being, if you're at 250 grand, your marginal tax rate's 45%. So if you're only getting taxed at 15%, it means that you have a 30% tax saving compared to the average punter who was only getting a 15% tax saving. So they wanted to even the playing field. Pretty fair, I think. So the simple planning mechanism that we put into place for our clients was don't earn over $250,000 a year if you can avoid it. So we use companies and trusts in order to distribute to lower tax beneficiaries to keep that under 250. And if we do have to go over 250, assuming that we've exhausted all other options, then 30% tax compared to 45% taking it personally is still a pretty good outcome, considering it's only 30% on the contribution, not on the earnings. So this gets to the next benefit. Tax on earnings in super is between 10 and 15%. So if it's short-term gains, it's 15%. If it's long-term gains, so held for more than 12 months, it's 10%. And then when you retire, you can convert your super to pension from age 60, and any earnings on that portfolio are taxed at zero, and any income that you draw from that portfolio is also taxed at zero. Phenomenal. There is no other tax structure we can get that kind of incentive. Now, what they then implemented was the transfer balance cap, which basically was that for people who have balances currently now over I think it's 2 million as of the new financial year. If you're over $2 million in your super fund, you can only have 2 million in pension. So only 2 million can have the zero tax, and then anything above that gets taxed at the 10 to 15%. Now the new rule, which is Division 296 tax, is an unrealised capital gains tax, which I think is stupid. But what it basically means is that for you as an individual, if you have a super balance over 3 million, you will be taxed on any unrealised gains that appreciate over that $3 million amount. So the simple rule here to work within is don't get your member balance over $3 million if you can avoid it. And ultimately, this comes down to understanding the rules. Super is a long-term bucket that we use to fund retirement. We want to maximise the tax advantages, but we also need to understand that, like any tax structure, the rules can change. Now, I like to think that the government tries to be relatively pragmatic around these things because they need to win votes. And I suspect that they're not going to make significant changes that affect the vast majority of people working towards retirement adversely. We like to think so anyway. So these rules affect a fraction of a percent of individuals, some of which have superannuation funds with balances over $1 billion. So this is about almost basically an ultra wealth tax. So the important thing here is make sure that you understand the rules, make sure that you have a financial strategy, and make sure that you're using those rules to the maximum of your potential as part of your financial strategy. For example, for many of our clients, we help them implement these small business tax concessions, which allow them to sell their business, capital gains tax-free in many circumstances, and get all of those proceeds into superannuation, also tax-free. So it's just about using these rules to your advantage, because the reality is you can't change the rules. All you can do is know how to play the game and play to your advantage so you win. Hope this helps. Any questions? Let me know.